All right, let's talk about something that makes absolutely no sense right now, the US housing market. It's a huge paradox, right? We're seeing the fewest people buying homes in nearly 30 years, but somehow prices are still sky high. So what is going on here? Let's dive in and figure this thing out. I mean, this is the big question, isn't it? It feels like it breaks every rule of basic economics we ever learned. In any normal world, when demand just falls off a cliff, prices are supposed to follow. But that is not what's happening. And to get why, you gotta look at the data. And this is where you can really see just how disconnected things are. On one side, you have sales volume that's cratered. We're talking levels we haven't seen since 1995. And keep in mind, there are 100 million more people in the country today. But on the other side, the median home price is just hanging out near its all-time record. So demand collapsed, prices didn't. And this is where the story gets really, really interesting. Yeah, this didn't just happen out of nowhere. It was the result of a very specific chain reaction, a series of dominoes that started falling, one right after the other, right at the start of the pandemic. So let's trace it back. First, remember when the Fed slashed interest rates? By early 2021, you could get a 30-year mortgage for 2.65%. That's a 50-year low. That, plus everyone suddenly working from home, lit a fire under the market. Home prices shot up 37% in just 2 years. But then, the next domino. Inflation hit a 40-year high, so the Fed had to slam on the brakes, hiking rates 11 times. And just like that, mortgage rates went from under 3% to almost 8%. And here's the thing you have to wrap your head around. We are talking about the exact same house. But the financial world you're in when you go to buy it, it's like two completely different planets. Look at this chart, it says it all. Back in 2021, a pretty standard $320,000 mortgage would have cost you about $1,300 a month. Fast forward to today, that exact same loan for the exact same house is now over $2,000 a month. Same kitchen, same backyard, totally different financial universe. That's an extra $730 coming out of your bank account every single month for 30 years. That number right there, that is the affordability shock that just slammed the brakes on the market. But it only explains half the story. It tells us why demand's disappeared. It doesn't tell us why the prices stayed so high. And for that, we need to look at the supply side. And this brings us to the real heart of the issue. It's the mechanism that's holding the entire market hostage, something economists are calling the lock-in effect. This is the key that unlocks our whole paradox. So this is what the lock-in effect looks like in the real world. Just get a load of these numbers. Over half of all mortgage holders in the US have an interest rate below 4%. A full 20%, 1 in 5, have a rate below 3%. These people are sitting on what is basically free money, and it's money they will likely never, ever see again in their lifetimes. This quote just nails it, doesn't it? That 2.75% mortgage, it's like a collector's item now. It's a financial product that you just can't get anymore. If you sell your house, you can't get that mortgage back. You're giving up an irreplaceable asset, and the price of giving it up is huge. So what does this actually mean? Well, for the average person, the financial hit just to trade their old mortgage for a new one is over $65,000. Why would you do that? You wouldn't, and people aren't. It's caused homeowner listings to drop by over 20%, suppressing almost 2 million potential home sales. So think about it. Demand vanished because rates got too high, and supply vanished because existing rates are too low. The entire market is just frozen solid. Okay, let's step away from the abstract market forces for a second and talk about the real impact this has on actual people. Because if you've been trying to buy a house and feel like you're just hitting a brick wall, you need to hear this. It's not you, it's the math. The math is broken. So let's take a person, we'll call her Maya. She's who this whole system is supposed to be for. She's got a good job, a great credit score, and she's been saving diligently for a down payment. She's done everything you're supposed to do. She is, by every traditional measure, ready to be a homeowner. But here's the cold, hard reality the market gives her. For a median-priced home in her city, the total monthly cost would be over $3,000. That would eat up a staggering 65% of her take-home pay. That's not just house poor, that's financially impossible. And Maya is not some rare exception. This is systemic. Nationally, there's a $22,000 gap between what the median household actually earns and the income you need just to qualify for a median-priced home. It's a fundamental mismatch that's baked into the system before you even open a real estate app. And you can see the downstream effects of this everywhere. First-time buyers used to be about 40% of the market. Now, they're just 21%. The median age for buying your first home has jumped from 28 to 40. And you have a huge majority of young people, 84%, putting off things like marriage and having kids simply because they can't find an affordable, stable place to live. So the big question on everyone's mind is, where do we go from here? A lot of people are hoping for and waiting for some big 2008-style crash to make everything affordable again. But all the data suggests that's just not in the cards. A quick side-by-side really shows you why today is completely different. Back in '08, the whole system was built on a house of cards, risky subprime loans. Over a quarter of homeowners were underwater on their mortgages. Today, lending standards are way higher and almost nobody is underwater. Homeowners are sitting on record amounts of equity. This market isn't fragile, it's just incredibly expensive and stuck. So the most likely path forward is something analysts are calling the slow grind. There's no big dramatic crash, no quick fix. Instead, what we're probably looking at is a long, frustrating period where prices just kind of move sideways, giving incomes a chance to slowly, and I mean very slowly, catch up. It's not a sprint, it's a marathon. So in the middle of this slow grind, what can you actually do? First, and this is the most important thing, ignore the noise. Focus only on your own numbers. Stick to that classic 30% rule. If a house is going to cost you more than 30% of your gross income, the math just isn't there yet. Second, remember that renting and investing the money you save is not a failure. In a flat market, it can actually be a really smart way to build wealth. And finally, look at new construction. Builders really want to sell houses, so they're often offering things like rate buydowns that can make a huge difference in your monthly payment. Look, if you take anything away from this, let it be this quote. If you've been struggling in this market, you're not failing at being an adult. You're trying to play a game where the rules are broken. Your frustration is completely valid. This isn't a personal problem, it's a systemic one. Which really leaves us with one final big question to think about. In a world where the math just doesn't work for millions and millions of people anymore, is the traditional American dream of owning a home actually broken? Or are we just watching it get redefined for a whole new generation?